Okay, let's unpack this. For decades, when you thought of wind energy, you pretty much thought of Vestas Wind Systems AS.
They were the benchmark, absolutely. The world's leading manufacturer of those massive turbines you see everywhere.
Exactly. But what the research we looked at for this deep dive shows is a strategic evolution that was way more ambitious than just building better blades.
Much more.
Between 2012 and 2024, Vestas just executed this massive pivot, and our mission here is to trace that journey. How did they go from being a pure hardware company, an equipment manufacturer,
Right.
to truly becoming a global sustainable energy solutions provider? And here's the key insight for you. This entire transformation, it was funded, driven, and basically made resilient by the growth of their service business.
It became their high-margin subscription engine. It was designed specifically to offset the wildly unpredictable nature of selling enormous capital equipment.
It was a boom and bust cycle.
It was. And this was an existential shift, really. Vestas had to stop being just a vendor and start becoming a long-term partner. This internal strategy turned them into what they rightly called a two-legged company.
One leg in manufacturing, one in services.
Precisely. And we're going to examine the 4 distinct phases that let Vestas strategically position that service segment as their financial backbone. They leveraged their huge installed base, which is, it's the largest wind asset portfolio on the planet, into reliable, recurring cash flow.
So let's start at the beginning. Phase 1, stabilization from 2012 to 2013. You really have to understand the trauma that came before this. The early 2010s were just brutal for Vestas.
Oh, absolutely brutal.
You had the global financial crisis, intense competition. They were saddled with excess manufacturing capacity, and worst of all, their margins on turbines were terrible.
Sometimes zero. Or even negative. This wasn't just a business flump. It was a genuine near-death experience that demanded a radical change.
So the primary goal in 2012 was pure financial triage.
Exactly. Stabilization, restoring profitability, and making sure that kind of panic never happened again. The vision wasn't just survival, though. It was about establishing those 2 robust, independent revenue pillars: new turbine sales and, of course, wind turbine services.
They realized that relying only on the hardware cycle meant they were just perpetually riding a roller coaster.
Oh, yeah, had to get off.
So they immediately elevated the status of the service segment. It was integrated right into the corporate structure, making sure that, maintenance plans and upgrades were considered right alongside turbine design from day one.
It wasn't an afterthought anymore, and the market responded immediately, which just proved how smart the strategy was.
How quickly?
Well, despite the company's overall crisis, service revenue grew a stunning 26% year-on-year in 2012. It hit approximately 886 million euros.
Wow.
It was, hands down, their fastest-growing segment. But the real magic was the profitability. The service EBIT margin stood around 17%.
Wait, 17%. Compare that to the turbine business, which was, scraping by near break?
That's the signal. It was an immediate, powerful sign of where the real value was.
But was that 17% margin truly sustainable, or is that just, them cherry-picking the easiest contracts at first?
That's a fair question. And while initial margins can sometimes be a bit inflated, they cemented that stability really quickly. The key was in the contracts. By the end of 2012, they had built a service order backlog of 5.3 billion euros.
And that number, that's future contracted revenue, right? Money they were guaranteed to receive.
Guaranteed. That kind of multi-year visibility is just golden to investors. It's the definition of resilience.
It's the financial cushion they needed against the turbulence of hardware sales.
And beyond the money, they built trust. They hyper-focused on reliability. They drove their fleet-wide lost production factor. That's the energy loss when a turbine is down to under 2%.
That's industry-leading stuff. Uptime is revenue for their customers.
It is. And this required data from the start. What the research confirms is that by 2012, they already had nearly 25,000 turbines, so about 43 gigawatts of capacity, all connected and feeding operational data back to them.
So even then, they had early remote monitoring.
Exactly. They could proactively schedule maintenance, minimize lost energy, and just get smarter. That successful stabilization confirmed services as a critical pillar, and it generated the cash and the confidence they needed for what came next.
Here's where it gets really interesting. Phase 2. Scalability. From 2014 to 2017, they stabilized the ship. Now it was time to grow aggressively.
The focus shifted to profitable growth. They wanted to capitalize on an installed base that had already swelled to over 60 gigawatts.
And that scalability phase, it focused on 3 key areas, didn't it?
It did. expanding globally, locking customers into much longer contracts, think 20 years instead of 5, and, crucially, entering the multi-brand service market. They realized their expertise wasn't limited to their own gear.
Organizationally, that led to the Global Service Division becoming a standalone business unit with its own P&L.
This wasn't a side hustle. It was a major global business.
Yeah.
And they introduced those flexible, customer-centric models, the AOM tiers.
Right, like a bronze, silver, and gold subscription. The AOM 1000 up to the comprehensive AOM 5000, which came with availability guarantees, like promising 98% uptime.
And to really accelerate that multi-brand push, they used targeted acquisitions. The first big one was in 2015, buying Upwind Solutions, a major U.S. O&M provider.
That gave them immediate boots on the ground in North America.
And multi-brand contracts.
Mm.
It quickly led to them securing that massive 1.75 gigawatt contract with Berkshire Hathaway Energy for a mixed fleet of turbines.
That's huge. That's a major utility trusting Vestas to manage assets made by their direct competitors.
Precisely. And they followed that up in 2016 by acquiring Avalon, a German independent service provider. That strengthened their European presence and let them service fleets from Gamesa and GE.
So by the end of 2016, they'd really become the global leader in multi-brand service.
They had. With roughly 8 gigawatts of non-Vestas turbines under contract, they genuinely became the trusted one-stop shop.
But didn't acquiring two different companies with different cultures, one in the U.S., one in Germany, create a massive integration headache?
It was a huge organizational lift, no doubt. But they focused on standardizing contracts and, really, on absorbing that regional expertise, especially the institutional knowledge of the competition's hardware.
And they weren't just fixing things anymore, they started selling value.
Exactly. They introduced life extension programs, inspecting and reinforcing older turbines to prolong their useful life by 5, 10, even 15 years.
So the service contract stops being just a cost center. It becomes a tool to increase the value of your customer's asset.
That's it. And they pushed performance upgrades, like Vestas Power Plus. These were clever software and minor hardware tweaks to increase annual energy output by, say, 2 to 5%.
And that 2 to 5% goes straight to the customer's bottom line.
Which justifies the premium service package. And the outcome just speaks for itself. The service order backlog soared from $5.3 billion in 2012 to a massive $10.7 billion by the end of 2016.
That growth proved customers were willing to pay for performance.
And that success funded the next leap. Phase 3. Digitalization and service innovation from about 2018 to 2020. They had the scale. Now they had to get high-tech.
This is where Vestas formally updated its corporate vision to global leader in sustainable energy solutions. It was a public signal that they were more than just manufacturing.
Right. And the digital backbone of this move was the 2018 acquisition of Utopus Insights, a U.S.-based energy analytics company.
So they basically bought a data science company.
They did. It gave them cutting-edge capabilities overnight, advanced forecasting, machine learning, predictive health monitoring, all integrated into their platform.
What's fascinating here is how that changed the whole maintenance philosophy. We're moving from preventative maintenance, changing parts on a schedule, to predictive maintenance.
Precisely. Predictive maintenance is about listening to the data to know the exact moment a part will fail. By 2020, Vestas was monitoring over 42,000 turbines, more than 100 gigawatts.
And they're using machine learning to process all that data. Vibration, temperature spikes.
Everything. An AI algorithm might spot a tiny bearing fault 3 months before a human ever would have. That early detection just drastically reduces catastrophic failures and unplanned downtime.
And their service offerings became incredibly performance-focused as a result.
Completely. Remote operations, fleet optimization using AI simulations, advanced forecasting to help customers avoid grid penalties. We saw clear examples where Vestas helped a client in Finland extend a wind farm's life to 30 years while boosting performance.
That market trust was really solidified during the Senvion collapse in 2019, wasn't it?
It was a key moment. When Senvion went down, Vestas moved swiftly. They secured long-term service contracts for about 800 megawatts of Senvion turbines across 8 countries. This was Vestas guaranteeing power delivery for entire communities.
It showed that trust and continuity were their real assets.
And the financial milestones from that phase are staggering. By 2020, service revenue was in the 2.0 to 2.3 billion euro range. The service order backlog nearly doubled again from 2016 to 23.9 billion euros.
Just to put that in perspective, that 23.9 billion is enough to guarantee Vestas' entire R&D budget for years, regardless of how many new turbines they sell.
It's the ultimate financial shock absorber.
Which brings us to the final stage, Phase 4, Integration and Energy Solutions from 2021 through 2024. This is the final step toward becoming that holistic provider.
The strategic focus here was unification and expanding their scope. Vestas formally structured its operations around three core businesses, onshore, offshore, and service, and supported them with a fourth, project development,
So they started moving upstream, securing sites and permits themselves.
which maximizes the chance of future turbine sales and the 30-year service contracts that come with them. They also unified their service practices by acquiring full ownership of MHI Vestas offshore wind.
So they could apply the digital excellence from onshore to the more complex offshore environment.
And the solution-centric model fully matured here. It led to things like energy as a service, where Vestas just guarantees an energy yield and the customer pays for that performance. They also started servicing hybrid solutions, wind, solar, and battery storage altogether.
And this phase also provided the ultimate stress test. The research shows that during 2023 and 2024, significant cost inflation squeezed service margins a bit.
They were modestly lower, yeah. High teens, around 20%. But here's the critical point. Even with that pressure, the service segment remained the reliable cash engine that kept Vestas healthy, even when the new turbine division was struggling or incurring losses.
The transformation was completely validated.
Completely. The scale by 2024 is immense. Service revenue hit approximately 3.7 billion euros, and the service order backlog reached an all-time high of 36.8 billion euros.
How huge is that? That single backlog figure, 36.8 billion, represents something like 8 to 10 years of contracted revenue. It's worth several times their annual turbine sales revenue.
And the operational footprint is staggering. By 2024, Vestas had about 155 gigawatts under service contracts globally. If you do the math, that's about a fifth to a quarter of the world's total installed wind capacity.
Serviced by 16,000 employees. They're not just selling a product, they are dominating the long-term stewardship of global energy assets. So what does this all mean for you? The synthesis is undeniable. Vestas successfully transformed from being just a product seller to a partner selling long-term outcomes, reliability, and lifecycle value. Their phased approach, stabilization, scaling, digitalization, integration was just executed flawlessly.
And that service business, it functions exactly like a sophisticated high-value subscription model in a heavy capital equipment industry. It provides essential resilience and predictable funding for their R&D. The focus shifted entirely from selling a product once to managing an asset for 30 years.
And that leads to a final provocative thought for you to consider.
The service business is now far more than just maintenance. It's a proprietary data and experience moat. Vestas' success demonstrates that the most enduring strategic competency in the future of the energy sector may not lie solely in manufacturing the best hardware, but in being the holistic energy solutions provider who can maximize the lifespan and yield of those assets. What does Vestas' enormous service backlog tell us about the long-term confidence investors have in the recurring, predictable nature of wind energy returns?
Thank you for listening to today's episode of our Digital Servitization Exchange podcast. We hope the insights sparked new ideas, challenged assumptions, and brought clarity to the evolving world of service and digital-driven business models. This podcast is grounded in extensive research across various fields, drawing on years of academic work, case studies, and cutting-edge publications. It also shaped by hands-on experience of our collaboration partners, whose real-world challenges and successes help us to translate theory into practice. If you enjoyed the episode, consider following the podcast and sharing it with colleagues who are navigating the civilization journey. Your support helps us continuing bridging high-quality research-based and practice-proven perspectives straight to your ears. Thank you for tuning in and see you in the next episode.